How do you steal billions? It takes time, planning, manpower, but the success will be more than anything else, down to the weaknesses of the institutions involved. Over the weekend of February 2016, a group of hackers managed to get away with $81 million. The stolen funds found their way to a major Philippine bank, the Rizal Commercial Banking Corporation or RCBC, and disappeared into thin air through Manila's secretive casinos. It was the stuff of Hollywood suspense and considered one of the biggest bank robberies of all time. This is the Great Bangladesh Heist. Good day. I am Joan Ognita and I am with my team members Mark Morales, Justin Nery, and Jerold Flores. In this presentation, we will analyze the corporate governance of RCBC with regards to its involvement in the Bangladesh heist. To start, let's look at the timeline of events of what happened. More than a year before the heist, on May 15, 2015, US dollar bank accounts under the names of Michael Cruz, Jesse Lagrosas, Alfred Vergara, and Enrico Vasquez were opened at RCBC Jupiter Street branch and left dormant. Fast forward to the day of the heist on February 5, 2016. An account for a certain William Sogo was also opened in the same branch. At midnight, $81 million worth of funds from the Central Bank of Bangladesh are transferred to the four accounts in RCBC Jupiter Street branch through its account in the Federal Reserve Bank of New York using SWIFT identifications. The timing of the heist was elaborate. No one was looking. Bangladesh Bank was shut down for the weekend, and it was Chinese New Year in Manila. Fed of New York tried to stop the transaction and sent a stop payment request to Maya Santos Digito, the branch manager of RCBC Jupiter branch. However, it was too late. On February 9, 2016, the $81 million fund was later found to be withdrawn and subsequently transferred to Mr. Go despite the stop payment order. He then transferred and exchanged the US dollar amounts to Philippine pesos through Philrem, a foreign exchange dealer. The funds are then distributed to the banks of Wei Kangsu, Eastern Hawaii Leisure Company, the operator of Midas Hotel and Casino, and Bloomberry Resorts and Hotel Inc., which holds the gaming license of Soleil Resorts and Casino. 2 days later, BSP received a call from the Central Bank of Bangladesh to seek assistance to trace and possibly freeze the funds that have been stolen. The request was immediately referred to the Anti-Money Laundering Council or AMLAC, which immediately triggered an investigation. The Senate Blue Ribbon Committee started the investigations on March 15, 2016. Among persons involved in these hearings were Maya Santos Digito, the RCBC Jupiter branch manager, Lorenzo Tan, the president and CEO of RCBC, representatives from BSP, AMLAC, Philrem, and the Central Bank of Bangladesh. The AMLAC filed money laundering charges against Ms. Digito and the holders of the four RCBC accounts. During a speech, Ms. Digito maintained her innocence as she claimed that she became an unwitting scapegoat and she made the wrong move of trusting Mr. Tan.
I am but a pawn in a high-stake chess game played by giants in international banking and high finance. If this committee is looking for the Grand Master, it is not me.
On the other hand, Mr. Tan insisted that he doesn't personally know Ms. Digito and RCBC has no knowledge of the alleged money laundering scandal.
These allegations are baseless and malicious. To set the record straight, I do not personally know Ms. Digito and
Now, before we deep dive into our analysis, let's look at the company background of RCBC as well as the bank's policies and governance. RCBC is majority owned by the Yotchenko Group of companies. As of December 2016, the bank was recognized as the fifth largest in the country in terms of assets. It also has a network of over 481 branches and 1,488 automated teller machines nationwide. Since its establishment in 1960, RCBC has been a pillar of the banking industry, providing a wide range of financial services to its customers. The board in 2015 was composed of 15 members, of which 4 are independent directors. In addition, the board committees include audit, risk oversight, corporate governance, personal evaluation and review, executive committee, trust, technology, and related party transactions. Note that before the Heist event in 2016, an anti-money laundering committee was not yet formed. RCBC's corporate governance manual is reviewed annually for the purpose of continually aligning its rules with pertinent regulations and issuances of BSP and SEC. In fact, these are even benchmarked against local and international leading practices. With all these corporate governance policies in place, what could have happened? Is it possible that these are just lip service?
Further to the corporate governance framework of RCBC, it was revealed during one of the Senate hearings that the company had set $22 million or 1 billion pesos as the bank's threshold before transactions are automatically elevated and flagged to senior management. East West Bank was also invited in the hearing and disclosed that their threshold for similar transactions was just $10 million. RCBC President Lorenzo Tan then explained that the threshold depends largely on the size of the bank. However, Senator Osmeña immediately countered that three local banks, which are far bigger than RCBC at the time, had thresholds of just $5 million, $2.5 million, and $1 million. As mandated by the BSP to all Philippine banks, RCBC also maintains a compliance committee, which meets at least once a week to discuss the possible filing of a suspicious transaction report. The process starts from determining the covered transactions, which are automatically generated by a computer system. From these covered transactions, the branch managers manually flag and select which transactions are to be covered by the review of the compliance committee. In the case of the Bangladesh heist, the head office sent branch manager Degito an order to file a report on the transaction past 9 o'clock in the evening of February 5, which falls on a Friday. Since it was a Friday night and the instructions were only sent via email, Degito was unable to read this until the morning of February 9, which was the first banking day of the week. It has to be noted that the branch was not open on February 8 because of the Chinese New Year. However, the system was offline on February 9, resulting in an additional day of delay. Thus, the report was only done by Degito 5 days from the day the head office requested the report. In the end, the delay in filing for a report was largely because of the requirement for a manual intervention for flagging suspicious transactions. But what are suspicious and covered transactions? The Anti-Money Laundering Act of 2001, or AMLA, laid down several characteristics in order to properly identify these transactions and to ultimately preserve the integrity of the banking sector. Transactions are considered suspicious when there is no underlying legal or trade obligation, purpose, or economic justification, or when the client is not properly identified, or the amount involved is not commensurate with the business or financial capacity of the client, or it may be perceived that the client's transaction is structured in a way to avoid the requirements of AMLA, or when there are circumstances that deviate from the profile of the client and or its past transactions, or the transaction is in any way related to an unlawful activity, or any transaction of similar nature. Moreover, Covered transactions are transactions in cash or other equivalent monetary instrument involving a total amount in excess of 500,000 in just one banking day. Once suspicious and covered transactions are properly identified, the banks are required to report the same within 5 working days from the time of occurrence. To effectively implement the provisions of AMLA, the BSP approved the updated anti-money laundering rules and regulations. This regulation applies to banks, foreign exchange dealers, money changers, remittance agents, and other financial institutions which are subject to BSP supervision and regulation. The policy describes the basic principles to combat money laundering, which includes knowing sufficiently the customer at all times, while preventing suspicious individuals or entities from opening or maintaining an account or transacting with a covered institution. But what is striking in the policy is that the BSP stipulates explicitly that the ultimate responsibility of fully complying with AMLA and BSP rules falls on the bank's board of directors. And on a more granular level, the BSP also requires procedures to mitigate risks associated with dealing with wire transfers, where a covered institution may unknowingly transmit proceeds of unlawful activities or funds intended to finance terrorist activities. One of these procedures pertains to cross-border transfers. Cross-border transfers amounting to 50,000 pesos or more shall include accurate and meaningful information about the originator. This includes the name, address, and account number. Should any wire transfer amounting to 50,000 pesos or more be unaccompanied by the required information, the beneficiary institution shall exert all efforts to establish the true and full identity and existence of the originator. This includes the requirement of additional information from the originating institution. If through the enhanced due diligence the result of validation remains unsatisfactory, the beneficiary institution shall refuse to effect the wire transfer or the payout of funds altogether. The drama of the Bangladesh heist dragged on for several months. In August 2016, RCBC was fined a record amount of 1 billion pesos by the BSP. However, the specific reason for the fine was not sufficiently disclosed. RCBC also quickly reorganized their board following the heist. They replaced 3 executive directors by adding 3 independent directors, which includes former SEC chairperson Lilia Bautista, former DBP director Gabriel Claudio, and former Citibanker Von Montes. RCBC President Lorenzo Tan was on leave during the investigation in 2016 and eventually resigned later that year. However, after resigning, Tan never left the Yuchenko Group. In 2017, he became a board member of the House of Investment, which is an affiliate company of RCBC. And in July 2019, he became its new president and CEO. RCBC Jupiter branch manager Deguito, along with the 4 unknown and fictitious account holders, were charged as the perpetrators of the heist. In effect, only Deguito was charged with 8 counts of money laundering. 3 years after the events of the case, in January 2019, the Makati RTC found Deguito to be guilty of all the 8 counts of money laundering, sentencing her to 4 to 7 years of imprisonment for each count and a penalty totaling $209 million. And with respect to the stolen amount, only $15 million were eventually recovered out of the total $81 million through Chinese junket operator Kim Wong. In 2013, the Financial Action Task Force, which is the global intergovernmental policy-making body on combating money laundering, removed the Philippines from its gray list, provided that casinos were included as a covered institution. Unfortunately, the final version of the bill that was passed to amend the law did not include such a provision. It was only until after the events of the heist in 2016 when the law was enacted to cover casinos, including internet and ship-based casinos, with respect to their cash transactions from gaming operations. However, in 2020, 2 of the biggest banks in the Philippines, BDO and BPI, were named in connection with the controversy surrounding Wirecard, which is a German payment processor. Wirecard's bank accounts with BDO and BPI were later on found to be fictitious. It seems that even after the events of the heist, foreign operators still seem to find the Philippine banking system as an attractive venue for dubious transactions.
Given the details surrounding the involvement of RCBC in this Bangladesh bank heist, we determine our point of view and problem statement as follows. We take on the point of view of the regulator, specifically the Bangko Sentral ng Pilipinas and the Anti-Money Laundering Council. Given the potential magnitude of money laundering cases, both of these institutions must be proactive in strengthening the sense of accountability over anti-money laundering policies across different levels in banks and other covered institutions. As such, we determine the problem statement to be as follows. How can corporate governance policies in financial institutions strengthen their anti-money laundering and know your customer procedures? We analyzed this case by determining what lapses in corporate governance over internal control were present surrounding the events of the case. First of all, had there been effective internal controls, money laundering would have been very difficult. This is illustrated by the fraud triangle on the left. For fraud to be mitigated, all three of the factors in the model have to be dealt with by the firm, namely pressure, rationalization, opportunity. In a sense, banks can influence best the factor of opportunity by ensuring effective internal controls. Even if there could have been personal pressures on the perpetrators, such as they might have been in dire need of money, or if the reason for the fraud was rationalized, as when the perpetrators think that top management may also be corrupt, the possibility of fraud could still be mitigated if there was no opportunity to do so. Opportunity to commit fraud is reduced by effective internal controls. However, in RCBC at the time of the heist, significant deficiencies led to the multiple violations in KYC and AML principles. First, the bank has set a relatively high threshold for reporting transactions to the head office at 22 million US dollars or 100 million pesos, which is significantly above those of other banks which are even larger than RCBC, as mentioned during the Senate hearings. This meant that perpetrators could easily get away with more stringent scrutiny as long as the transactions are below such limits. Second, the stop order request was not heeded on time because the branch was not operational when it received it. This raises doubts as to whether the head office should have been able to act on the request digitally, since such a request from the Fed of New York was duly received by the Settlements Department, which is the one that cascades the request to the branch. At that time, action could have already been made to heed the request digitally instead of waiting for the branch to open. Unfortunately, the stop payment request, originally sent on Feb 5 in the evening and resent on Feb 8 on a holiday, was only allegedly received by the branch manager only after the withdrawal of the funds were made. Finally, whether inadvertently or not, the branch manager of the Jupiter branch was playing both the sales role and the compliance role. This is a clear violation of the principle of segregation of duties, since the sales function should focus on increasing revenues, while the compliance function should focus on ensuring that each transaction is valid and properly documented. The internal controls do not only refer to those that are implemented on the branch level. Higher-ranking officials should also have been proactive in ensuring that proper controls are in place. The BSP noted that sound risk management policies include adequate and active board and senior management oversight and appropriate monitoring and management information system. RCBC was lacking in these two areas. First, we noted that there was no dedicated board committee for anti-money laundering. Furthermore, the fact that the bank just forwarded to the branch manager the request to assess whether the transaction was suspicious shows that higher-ranking officials were not quite hands-on regarding anti-money laundering procedures. Had there been better oversight at higher levels of management, alleged rogue employees could not have perpetrated the act. Second, the branch and higher management also should be responsible for ensuring that the IT system of the bank is appropriate for its needs. It was suspicious that there was an outage in the system the day after Chinese New Year, which further delayed the expected action on the stop payment request. Furthermore, the bank was not able to utilize its base 60 system, which was touted to be able to automatically detect suspicious transactions given the circumstances of each transaction. In the case at hand, the fact that the accounts were inactive for more than 2 years and suddenly received a deposit from a central bank for a total of $81 million should have been flagged. Needless to say, the high threshold previously discussed contributed to the bank's failure to sufficiently flag suspicious transactions as well. And yet, only the direct perpetrators and covered persons can be convicted under current AML regulations. We see this in the fact that the DOJ only convicted branch manager Santos de Quito despite obvious lack of internal controls in place. The AML only considers those who were directly involved or made decisions in the case can be construed as having committed the act of money laundering. However, we think that higher officials are at least indirectly involved. On the one hand, the board of directors assumes ultimate responsibility in fully complying with AML regulations. As such, if there were lapses in these policies, they should also be penalized. Second, the bank itself recognized in its corporate governance manual that the CEO shall ensure the internal controls are adequate and effective in ensuring compliance with laws, rules, and regulations, and that includes those related to anti-money laundering. Evidently, certain members of the board and the CEO should also be penalized for the lack of proper internal controls in this area.
Based on our analysis, there is a clear lack of board oversight and internal control measures to prevent the Bangladesh transaction from happening. This provided rogue employees the opportunity to engage in fraudulent activities. We now provide our recommendations. First, since trust and confidence is paramount in the banking industry, financial institutions must have the highest standards of internal controls. We propose Sarbanes-Oxley type of reforms, which includes the following. The CEOs and CFOs of banks should be required to confirm their responsibility on the internal controls over the financial reporting and anti-money laundering activities of their respective banks. The CEOs and CFOs are also to explicitly state that they deem such internal controls as effective and that they are responsible for any lapse in internal controls. Second, a verification of the internal controls should also be done by an independent third party. Thus, we also propose that external auditors should also express their opinions of the internal controls placed by banks. Finally, we propose the disclosure of board discussions on the design and implementation of internal controls and anti-money laundering measures in the management discussion and analysis section of the bank's Form 17A. This will improve the transparency over the bank's actions in preventing money laundering and terrorist financing. Our second recommendation is to establish a separate rule for KYC compliance and account monitoring. Currently, the responsibility of the KYC compliance also falls under the branch managers, who are also responsible for the bank's sales and to ensure customer service. This presents an opportunity for fraud to happen because of the overlapping objectives between compliance and profitability. By separating the KYC compliance function, an additional layer is added that focuses solely on compliance, which can have its own KPIs that are different from the KPIs of sales and customer service representatives. It is also important that both groups are not allowed to personally interact with each other to prevent any connivance from happening. Our third recommendation is to impose stricter penalties to board members to improve accountability. In the aftermath of the case, the DOJ failed to convict any of the board members because none were proven to be directly involved in the scandal. However, we draw from the Anti-Money Laundering Act, where it explicitly mentioned that the ultimate responsibility of fully complying with AMLA is the board of directors. Thus, while the board was not directly involved, They should have been penalized for the lack of internal control measures to prevent the scandal from happening. The decision makers, which includes the CEO, CFO, chairman, and audit committee, should be asked to pay a fine and should be banned from holding any directorship for a period of 5 years. Our fourth recommendation is to lower the threshold for suspicious transactions to a level that is at par with the rest of the industry. A lower threshold means more transactions will be monitored, which will make it more difficult for criminals to achieve their goals and can help RCBC identify suspicious patterns due to the additional transactions required. To supplement our recommendation, we also advise the use of data analytics to come up with an algorithm that could help identify suspicious transactions based on patterns. Using data analytic tools will make it more difficult for criminals to circumvent anti-money laundering policies. This will be used as a supplement to the base 60 system that is currently being used by RCBC. We also think that it's important to have a system that can operate 24/7 to avoid suspicious activities during holidays or when the system goes offline. Our last recommendation is to establish and institutionalize an AMLA committee whose primary role is to focus on the anti-money laundering compliance of the company. That is it for our presentation, and we are ready for your questions.